Rising mortgage rates just added $4,200 to your dream home's annual cost. Mortgage rates are near 6.5%, affecting home buying and refinancing. You'll learn how this surge impacts your budget and the broader economy, including a surprising effect on your monthly payments. Mortgage rates have surged to near 6.5%, making homes more expensive. For a $500,000 home, a 6.5% rate means a monthly payment of $3,160, compared to $2,264 at 4%. That's $896 more per month, or $10,752 per year. And it's not just buyers. The economy feels the pinch too. For instance, in cities like New York or Los Angeles, where homes are often over $1 million, the increased rate could add over $20,000 to the annual mortgage payment. But what's driving these rates up? It's largely due to inflation concerns and the Federal Reserve's actions to combat them. As the Fed raises interest rates to curb inflation, mortgage rates follow suit. This has a ripple effect, impacting not just housing, but also consumer spending and economic growth. So, how do you navigate this as a buyer or homeowner? We'll explore that next. For example, consider a scenario where you're buying a $750,000 home in San Francisco with a 20% down payment. At 6.5%, your monthly payment would be approximately $4,300, compared to $3,200 at 4%. This difference of $1,100 per month can significantly impact your budget and financial planning. Historically, high mortgage rates have led to decreased demand in the housing market, which can eventually lead to lower home prices. However, this process can take time, and in the meantime, buyers face higher costs. To mitigate this, some buyers might consider adjustable-rate mortgages or exploring different neighborhoods. Back in 2008, when mortgage rates were around 6%, the housing market experienced a significant downturn, leading to a drop in home prices. Similarly, today's high mortgage rates could eventually lead to more affordable housing, but it's crucial to understand the current market dynamics and plan accordingly. But the part that surprised me most is how this affects your overall financial plan, including your 401k. That's what's coming up next. You'll learn how to reassess your budget and make adjustments to mitigate the impact of higher mortgage rates. For instance, you'll discover how a 1% increase in mortgage rates can reduce your disposable income, forcing you to make tough decisions about where to allocate your funds. The increase in mortgage rates doesn't just affect your monthly payments. It also has a broader impact on your financial planning. For example, if you're planning to buy a $750,000 home in a city like Chicago with a 20% down payment, your monthly mortgage payment at 6.5% would be approximately $3,785. This could force you to adjust your budget, potentially affecting your ability to save for retirement or other goals. Historically, high mortgage rates have led to decreased demand in the housing market, which can eventually lead to lower home prices. However, this process can take time, and in the meantime, buyers face higher costs. To mitigate this, some buyers might consider adjustable-rate mortgages or exploring different neighborhoods. But what about the overall economy? High mortgage rates can slow down economic growth by reducing consumer spending and housing market activity. For instance, a study found that for every 1% increase in mortgage rates, housing starts decrease by about 8%. This has a ripple effect on employment and economic output. And what about the misconception that you should always opt for the lowest rate? Not necessarily. The terms and conditions of the loan are equally important. Consider the case of a buyer who opted for a 30-year fixed-rate mortgage at 6% instead of a 15-year fixed-rate mortgage at 5.5%. While the 15-year mortgage has a lower rate, the monthly payment is higher due to the shorter loan term. In this scenario, the buyer might be better off with the 30-year mortgage, despite the higher rate, as it allows for more flexibility in their budget. We'll delve into more strategies for navigating these high rates in our next section. Now, let's talk about a contrarian view. Could high mortgage rates actually be a blessing in disguise for some buyers? That's what we explore next. You'll learn how high mortgage rates can lead to lower home prices and more affordable housing, and what this means for your financial plan. For example, we'll examine how the 2008 housing crisis led to a surge in affordable housing, and how today's high mortgage rates might have a similar effect. While high mortgage rates are generally seen as a negative, there's a contrarian view that they could be beneficial for some buyers. High rates can lead to lower home prices as demand decreases, potentially making homes more affordable in the long run. For example, in 1981, when mortgage rates peaked at over 18%, the subsequent drop in rates and home prices made buying a home more accessible for many. Similarly, in today's market, if you're in a position to wait, high mortgage rates could eventually lead to better buying conditions. Another historical parallel is the early 2000s, when low mortgage rates fueled a housing bubble. High rates can prevent such bubbles from forming, protecting buyers from overheated markets. However, this requires a long-term perspective and the ability to wait out market fluctuations. For instance, consider a buyer who is planning to purchase a home in a few years. If they can wait, high mortgage rates might lead to lower home prices, making it more affordable for them to buy. On the other hand, if they need to buy immediately, they might consider exploring different neighborhoods or opting for a shorter loan term. Additionally, high mortgage rates can also lead to increased rental yields, making real estate investing more attractive. We'll summarize the key takeaways and provide an actionable next step in our conclusion. So, how should you respond to these high mortgage rates? First, reassess your budget and consider how a higher monthly payment fits into your overall financial plan. If you're planning to buy, you might need to adjust your price range or consider different loan options. For current homeowners, it might be wise to lock in a fixed rate if you haven't already, to protect against future rate increases. Additionally, exploring ways to increase your income or reduce other expenses can help mitigate the impact of higher mortgage payments. It's also crucial to keep an eye on the housing market and economic indicators, as they can provide insight into where mortgage rates might be headed. For example, if you're considering buying a home in a city with a growing job market, you might be more likely to see increased demand and higher home prices. On the other hand, if you're looking at a city with a declining job market, you might see lower demand and more affordable housing. By understanding the local market dynamics and adjusting your strategy accordingly, you can make a more informed decision. Remember, high mortgage rates are not just a personal finance issue, but also a broader economic one. By understanding the reasons behind these rates and taking proactive steps, you can better navigate this challenging market. And that's what we've covered today. To recap, rising mortgage rates significantly impact your budget and the housing market. Your key takeaway should be to reassess your financial plan and consider how higher mortgage rates fit into it. As a next step, review your budget and explore options for mitigating the effects of higher rates. Consider creating a contingency plan for potential future rate increases, and explore ways to reduce your expenses and increase your income. For instance, you could consider reducing your daily expenses by 10% and allocating that amount towards your mortgage payments. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about mortgage rates, hit subscribe. I break down one of these topics every week. Take control of your financial plan and make informed decisions about your mortgage and housing market strategy. By doing so, you'll be better equipped to navigate the challenges of high mortgage rates and achieve your long-term financial goals.